And welcome back to the Morgan Streetman Show on Money Talk 1010. Today we've got some very special guests with us from Metalla Royalty and Streaming Company, which is ticker symbol MTAFF. And we've been talking a lot about Metalla today in terms of it being a potential investment. Now, of course, none of us here are investment advisors, and we're not trying to give people investment advice. We're really just sharing our own personal stories. I'm actually a shareholder of Metalla myself, and these are a couple of friends of mine over a long period of time, and some really, really great guys that I really trust. And so I wanted to bring them on because not only do they have knowledge about the company that they're involved in, Metalla, but they also have all this additional knowledge, and they look at the world in ways that at least I think are pretty darn reasonable and logical. And, of course, as you know, if you listen to the show all the time, we don't think most of the people that you can hear out there are looking at the world in a reasonable way and trying to bring you the truth as they know it. But that's what these guys have always done when I've talked to them with me, and that's what they're here doing with us today. And one of the things we wanted to get to, one of the pieces of truth we wanted to talk about is what the Federal Reserve has actually done to our economy over the past decade, where they've had artificially suppressed interest rates.
Well, the first thing people need to understand is anything named by the government, you've got to take the opposite. So if you take the food safety law, this makes food dangerous. Okay, so everything the government does is a naming game. Federal Reserve, it's about as federal as Federal Express. Okay, so the banks own the Fed and control the Fed. And the original purpose was to create some stability with money flows. You know, after the earthquake and fire, early 20th century in San Francisco, there was a lot of money that was just surging in and out of the country to rebuild. So it makes sense that you have some sort of body kind of governing how money flows around. But the problem is that the Fed is completely beholden to the banks, and the banks aren't necessarily have any consideration for the people. So the Fed has been very involved in the U.S. economy for the last 15, 18 years. I mean, prior to that, it wasn't that involved. I mean, it was kind of a banking regulator type function, but now it's involved a lot. And you hear Trump talking about the Fed, and you hear the Fed making all these statements. And the Fed will be involved in the U.S. economy to the degree it is now until it explodes. And ultimately that will happen because you have a debt-based economy now. You don't have a savings-based economy. You have a debt-based economy. It has to have more debt, cheaper debt, constant debt.
Right. The way new money is created in our economy is through the issuance of new debt. That's the only way that money comes into existence in our country. Is with accompanying debt.
That's right. So you had the Federal Reserve's balance sheet was maybe $800 billion prior to the crisis, and now it's been as high as $4.5 trillion. I mean, maybe it's like $4 trillion now, and we think that number is going to get much larger. So you've seen evidence of that recently. I mean, the banks had announced they had tough earnings because the mortgage refinancings went down because rates started going up, and sure enough, now you hear, well, maybe we'll stop raising interest rates. Maybe we'll even lower them.
Yeah.
So that's what's coming. What the Fed does, I really want people to understand this. If you invited me to your house and I went to the restroom and started a fire in the restroom, and then I came back to dinner and sat down, and then I said, oh my God, the bathroom is on fire. I'll put it out, right? Oh, you're such a great guest. You've saved the family. Right. No, I basically created a problem and then acted like I saved the family. So what the Fed has done right now in the last month, it's very important to see what they've done. They've said, we'll be patient, we'll see what's going to happen, maybe we'll even – okay, if the market has a shock, so let's say the stock market goes down 10% and everybody's on fire, and the Fed says, we'll rescue, okay? We'll come in and rescue, but we're going to have to do this and these things, which would be controversial right now. Because people right now would say, well, you're just printing money.
Right.
But once there's a crisis, okay, do whatever you need to do.
To fix the crisis.
That's right. Just do whatever you got to do. And everyone kind of overlooks the small price that they'll say you have to pay. Okay, so that's what's coming. And it has to be that way because otherwise the system is over.
And we also kind of saw that kind of distortion in the market itself. And that's what the Fed's been doing the last 10 years. I mean, it was very stark when President Obama came into office. Essentially, the Fed dropped the interest rates to what is the equivalent of basically zero, and that's the Fed funds rate, and that's the rate from which all the other rates are determined.
That's right.
Because that's kind of like the first rate.
Right.
The first lender is the Fed, loaning the money to its member banks through its window, which, isn't available to just anybody. You have to be one of the member banks to borrow from the Fed at that interest rate.
Right.
And so what we're talking about, though, is that the Fed dropped the interest rates from it was about 1% to 0 and then maintained them at 0 for essentially the entirety of President Obama's presidency. Now, not only was it unprecedented for them to drop the rates that much in one move, normally they go up or down by what they call 25 basis points, which is 0.25%, not a full percent, but 0.25%. That's normally how much they move it. So for them to drop it 4 times the normal move at once was a pretty severe action, and it was designed to stop the natural functioning of the market, which is that they had released too much credit into the market. Prior to that, we had the huge housing bubble, and then when the economy fell apart, basically we were due for the second Great Depression.
But they did something else that most people overlook, is that they stabilized the mortgage market for the benefit of the banks. So they bought mortgage securities.
Right.
And then they also bought United States treasuries because the government needed to issue, say, $1 trillion extra in treasuries than it had the capacity to. And what they did is, this was a little scheme, is they told their member banks, you buy the treasury bond in the auction, and then we'll buy it from you at a slightly higher price, which will give you a little profit, stabilize the banks. Because remember, people thought Bank of America, $3. People thought banks would fail. So this was all part of a plan. Now, it wasn't a nefarious plan. It's just a plan to put the good times back, turn the music back on,
Never let the party end.
Exactly. Yeah. Now it's a long time. The party's been going on for a long time.
Right. Yeah. We've had an additional 10 years of not having to pay the piper, not having to pay for what we've been enjoying.
Now, why does that matter? Okay, so why that matters is because it's a law of the human psychology that as time goes on and money is easy, people start doing foolish things with money. Okay, so you've probably seen this in your personal life. When times are tough, you're really kind of careful about things. But then you really start to slowly get lazy. And then by the end, you start doing things that you would never do if things were tight. This happens in business. Businesses, they're careful after a downturn. But at the end of the downturn, they say, let's get into that other business that we have no business being in.
Yeah.
And this is what the government does, and let's build a bridge to nowhere, and let's build a bunch of parks and things. We'll sell some bonds, and we'll take care of it later. And then if the revenue dries up, if tax receipts dry up, then that's when that's what causes all crisis. Personal life, business, government, it's all the same. So we've prolonged that so far now that when it ultimately hits, it's going to be much worse than it normally would have been.
And when it does ultimately hit, we're probably looking at a pretty severe correction, which, while we had a sort of an economic slowdown after 2009, we didn't have the kind of severe correction that we were expecting, like a la the Great Depression. Now, the thing about these corrections is they don't last forever typically, but only if you take your medicine in one sip. What we're trying to do is put off taking our medicine or sort of spread it out over a long period of time, and we're not ever paying for all this that we're enjoying. We've been borrowing money now for decades, and at some point somebody's got to pay all this back, so to speak.
Well, that's not going to happen.
Right.
So we'll continue and push it out even further. But to compound that, look at the retiring generation right now. Where's all their money? It's either in their home, their biggest asset that they own, or it's in a 401k, which means that it's in the S&P 500.
Yeah.
And so if you have a market correction, people immediately are going to fear for their future. They're going to say, look, thought I was ready to retire. What are you telling me? I'm going to work 20 more years? I'm not going to do that. I'm falling apart.
Your pension's gone.
Exactly. And then you have this great downsizing where people need to sell homes. Because the 65 to 70 generation, they have a different taste in homes than people coming along nowadays. It's kind of, I don't know how we're going to reconcile this, but you're selling this house and the market's not there for the house to be sold, and then you're trying to take some money from your 401k, and the stocks are down 15% or something, and you don't want to do that. Okay, so you can see how all this is set up perfectly, and then as the dominoes begin to fall, that's when you'll have the Fed come in and say, okay, we have a plan. We have a cute name for it.
Mm-hmm.
We've come up with a very interesting name. It makes you feel good to say it. Write articles about it, and Paul Krugman will tell you that it's really smart to do this. So you can see how all the people come out, and they come and line up to support this, and this is how it'll go. Now, here's why this matters. Okay, this is not about someone's conspiring against you. Why this matters is you have to see this and say, what am I going to do in order to be able to survive and potentially even thrive as this obvious sequence of events plays out.
Mm-hmm,
okay?
Mm-hmm.
And if you can do that, you're going to enjoy it.
Yeah. And one of the things that people do when they're thinking about how am I going to survive, how am I going to thrive, they think, let me hedge my bets a little bit. Let me put some money into something that's kind of outside of the traditional markets, and that is something like precious metals, which have been used as money for the entire history of human history.
Yeah.
But yet kind of exist outside of the market forces that are affecting things like our mortgages and our house prices and things like that. Gold is on kind of a different track.
Well, gold is money. Okay, so what's in your wallet is not money. That's government currency.
Mm-hmm.
Okay, so money is something you can exchange at any time for government currency of any flavor. And so that's why gold's important. Now, that matters when all these things begin to happen, that government currency is serious risk.
Right.
You might be paying $100,000 for lunch 50 years from now.
Right,
Okay,
right. Like Venezuela.
Exactly. So, with gold, that doesn't matter because you can then turn it back into government currency and buy something.
Brett, why don't you tell us real briefly about some of the most exciting projects that you're involved in right now with Metalla?
Well, Morgan, we recently just acquired a portfolio of 18 royalties from a multi-billion-dollar gold company. And, it was a big transaction for us. It really increased our critical mass. And that's important for investors because, what we want to provide is a diversified way to get all the leverage and predictable cash flows from these gold miners. And that translates directly back to the investors. And it does that through capital appreciation. It does that through dividends. And it just does that through the growth of our company and our business. And as we've gone and built this thing from zero up to, about 150 or so million in market cap in a couple of years. So it's a business that is not relatively known very well for kind of the generalists out there. It's a place where a lot of smart money has kind of hid in this sector for a while, and that's why we wanted to build this. We wanted to build this for, the people to get exposure, to be able to have products that would protect them through tough times.
Yeah. Well, let's pick up with some more of that discussion on the other side of the break because that's some very interesting stuff, Brett. And then we're going to get into our Out There segment. So, folks, stick around. Thank you for listening to the Morgan Streetman Show. We hope you enjoyed what you heard, and if you did, please click like and subscribe to help us out. And remember that we recommend that you exercise your brain at least once a week.